Hello and welcome. I'm Dave Whitmore. Thanks for joining us for this short video to see how to use stock index futures to trade overall stock market moves. But first, what's a future anyway? Well, it's a contract for a future transaction, a purchase and sale of a commodity or financial instrument at some particular date in the future. Originally, agricultural products were the center of futures markets. Today, financials have taken over, in large part because of the huge institutional interest and value in trading them. Stock portfolio managers can use them to hedge. Index funds use them to replicate the performance of indexes. There are large commodity funds called pools, which trade large percentage of activity in a variety of different commodities. On the other side of those trades are speculators. You and me, perhaps, individuals and professionals who attempt to profit from swings in price of those commodities. And those two sides of the coin, hedgers and speculators, are the central purpose of why these markets exist. What attracts traders to futures? We'll offer 6 reasons. The first is leverage. With a relatively small amount of risk capital, you can control a relatively large amount of value, and here in this case, stock value. The market strategies are pure in the sense that they're simply large macro global themes. Stocks versus interest rates, gold and oil, not the minutia of stocks where we need to be concerned with, for example, quarterly earnings reports and sales reports. In the futures market, you can go into a bearish position very easily. You simply sell the contract. Shorting stocks involves borrowing shares. Options involves other variables like strikes and expirations, so very easy to make a bearish trade in the futures markets. A lot of liquidity, especially in the contracts that we're showcasing, or I should say focusing on here. Certainly there are markets which are less liquid, but there's a lot of liquidity in the stock market indexes. Short-term traders will find that there are no curbs or onerous requirements on shorter-term trades called day trades. In the futures market, the holding period is not of concern. And then finally, around-the-clock trading, or at least pretty much. 6 days a week, the market opens at 5 p.m. on Sunday, closes at 5 p.m. on Friday, and each day in between during the week, it closes from 5 to 6 p.m. for a maintenance period. So what's out there? The markets that are available are basically physical commodities and then financial commodities or financial futures. And the physicals are things like gold and silver and crude oil and corn and soybeans. The financials are up here on top. And in our discussion here, we're focusing on the stock index futures. And you can see the S&P 500, the NASDAQ 100, the Dow, and the Russell 2000. Where do we find information about these contracts, about these futures? Well, there's a couple of places that we'll be using. One is when we come to placing a trade, it's the Power E-Trade platform that we're going to use. But you'll also find valuable information in the Markets and Ideas menu. And if you scroll down to Futures and click that, you'll come to a page that's got a lot of useful information. In particular, if you scroll down, you'll come to the heat map. The heat map shows market data for the range of futures products that are trading out there. So you can see here, we've circled equities. You can see the S&P 500, the NASDAQ, the Dow, and the Russell. And if you look down in the lower left, you'll see micros. And so this introduces the idea of the contract, and the term micro signals that this is smaller. And so indeed it is. If we want to get a closer look at that, we can click any one of these tiles. But before we do, let's look at some data on the trading activity of these contracts. So here is one particular trading day. We simply tallied up at the 5 p.m. close what the total volume for that day was. The green bars represent trading in the micro contracts. The purple bars represent trading in the fuller sized contract. And you can see very large trading activity, well over almost 2 million contracts in the micro S&P. The other observation to make is how much more the trading focuses on the S&P 500 and the NASDAQ 100 when compared to the Dow and the Russell 2000. So again, still large liquidity, especially in the NASDAQ and the S&P 500. So back to the contract page. This page will give you a lot of summary information. You can see things on this page like the margin requirement, the contract unit, the minimum price fluctuation. You can see the value of the index. And yes, you can use those charts for general purposes, and you can customize them to some degree, but I think you'll find the Power E-Trade charts to be superior. At any rate, the information on this page is important. Let's look at it in a comparison way, looking at the ES contract and the micro contract. So it starts with the index value, and it's the same for both of these. Now, it's not necessarily always exactly the same. They're usually precisely in tandem or just about, but they can be off by ticks. If you look at the bids and the offers, they're generally going to be the same. But it is the index value of this particular contract. Remember that. It is not the same as the index that you see in a cash value if you're looking at, say, the SPX. And then there's the contract size. And with financials, with stock indexes, we just multiply it times a dollar amount. And so in the case of the ES contract, that's $50. And in the case of the micro contract, it's $5. Multiplying those numbers, the index and the contract size, gives us the notional value. So this is the value of the stock in the contract that you are controlling by either buying or selling it. And then there's the margin requirement. So this is the money that you have to put up or deposit in order to make that trade. So taking a look at the notional value and the margin requirement gives us a clue into the kind of leverage that's available in these trades. So in the micro contract, we are controlling $21,000 worth of stock for $1,254. Now that we know these numbers, we can take a look at how those values change. And so we have a minimum tick in futures markets, 25 cents or 0.25. So that means the index value goes up or down in that increment. So not in pennies, but in 25-cent increments. Knowing the minimum tick and knowing that the contract size is $5 times a point or $50 times a point means we can translate that minimum tick into the dollar value of one tick or the dollar value of 1 point. And then while it's not on that information page, I think it's worthwhile to do a calculation to figure out, well, what is a 1% move to the equity in the account? Because 1% moves are not necessarily all that uncommon. So that's a run through of the two contract differences. And it's really just a matter of 1/10 the size. And these micro contracts have great liquidity and interest in trading. The margin is really simple. It's got to be in the account to place the trade. So that's point one. And then the value of the account is marked to market. And so if the value of the index rises and year long, the equity in your account will increase by that number of points times the $5 multiplier. And then if it goes the other way, if the equity in the account falls below a minimum requirement, it'll need to be brought back up to the initial requirement. And that will happen automatically because your futures account will always be linked to a brokerage account at E-Trade. If the account doesn't meet any shortfall, it is subject to liquidation. Certainly something to pay attention to. So back to our trade. We'll go to Power E-Trade and walk through creating a position and liquidating it. So when we're in Power E-Trade platform, remember we're going to use the slash with our symbol. So here we've got /MES. When we enter that, the drop-down menu will give us the various contracts that are available. You might also want to use the quote tab here to give some background information on the particular contract or underlying that you're interested in. So for instance, when we move over here, we see the minimum tick information that we've been talking about there. This is the micro, so that point value 5, that's the multiplier. So 5 times whatever the index point moves translates into a tick of $1.25. And then down below, you'll see the volume in the various contracts for this index. And one observation to make here in this particular sort of somewhat special case is notice that the trading volume in the second row, the June contract, is much more than the trading in the first row, the March contract. Notice if you look over to the right that the March contract has 1 day left until expiration or delivery date. trading is migrating to the June contract. And so this is what happens each month as an expiration and delivery date approaches, trading will move through into other contracts, something to pay attention to. So let's place an order. Quotes are always linked. If I want to place a buy order, I can click the ask. If I want to place a sell order, I can click the bid. So let's say we clicked the ask, and that'll bring up a pop-up order ticket. The order ticket in a futures trade is pretty straightforward and simple. It's buy or sell and quantity. Yeah, you have some order type choices. You can use market orders or limit orders. You can use stop orders, and there are some more advanced conditional orders that are available as well. You might also use the trading ladder. This is a very efficient way to set up trades. First off, notice up above the efficient order entry up here where I can quickly generate buy or sell orders and quickly change my quantities in order to hit a market quickly. I can follow the depth of the market more than just the bid and the ask. Now I see the number of contracts bidding above and below the current bid and offer. It's also integrated with my orders. Here you can see the order to buy at 42.20 that we had just done, and we'll also see that over in the order book. Now, we'll imagine our trader has canceled that limit order and went ahead and bought it at the market. So you can see here it shows the cancellation of that one trade at 42.20 or the one order at 42.20 and a fill of an order that we entered at the market. So now we are long one contract, and that shows up in the ladder. You can see our position there, one contract. We're up $1.25 on the position at this point. You will also notice now we got some additional order functionality here. We can either flatten any position we have or reverse it very quickly with these buttons here. Reversing when we have one long contract would be to sell two. Selling two would flatten the one contract and make us short the second one, going from long one to short one. We also have, if we have open orders in, we can quickly cancel very quickly if there happen to be sudden moves being made or if we've had a sudden change of heart. We also have more order and account detail up in the accounts menu. You can see orders and positions, account position details with, of course, a wide range of choices in columns for your display. And as is the case throughout Power E-Trade, if you click on a row in a positions or in a watch list, you'll get an action box. You can get a quote from here, go to a chart, add to a watch list. If you want to close out that trade, there's a button right here for that. When we're long, a closing trade is a sell. So here is our order to close out our position, and hopefully your trade was a profitable one. And let's talk about the opportunity for profit and the risks that exist in price moves in futures. We've been talking about the leverage that's available. Let's observe it in real dollar terms. Here's a 15-day period where the S&P rose about 5%, 230 points. Remember the math of our trading here. 230 points times $5. That's our multiplier is plus $1,150. So had you been long, you would have gained 92% profit based upon the $1,254 margin requirement. Of course, if you were short, you would have lost that money had you stayed with the position the whole way and continued to meet the margin that would no doubt would have been required. Here's a 300-point drop that amounts to a $1,500 swing. So these are bigger moves, holding a position for 2 or 3 weeks. But remember, that's not the full story, because we've already made the observation that these markets trade nearly around the clock. And so let's take a look at the kinds of swings that are possible here. So here we're looking at 5 days, and our candles or our bars are 15 minutes. You'll notice if you look at the volume bars below the price area there, you'll see these periods where there is very low trading volume. Well, guess what? That's overnight. And certainly you can see those big swings that occurred right there in that overnight period. Here again are the overnight periods. And I just want to simply point out that not very different types of swings can occur in these overnight periods. So I guess 3 lessons there. 1, there's opportunity even when the stock market has closed. If you pay attention to world events, there's opportunity to trade the S&P 500. It also means there's meaningful risk that can be introduced swiftly overnight. So at any rate, that's the main point here, is that there's swinging prices that can be exploited by proper trading strategies and entries and exits. And so that's the attraction of the futures markets. So what about a wrap up? Futures offer active traders a liquid market and leverage trades on the major stock indexes. We'll leave it to you to consider how futures might fit in your own active trading strategies. Thanks for watching.